Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Brian Wieser joined us, Madison and Wall. And what's great about Brian Wieser is it's less buy, hold, sell, and much more what in God's name are they doing? What's the single myth of Facebook Meta that our listeners and viewers have? What's the thing that drives you nuts?
The myth that advertisers care about all the problems on the platform and that they will care. They care about performance, for better and worse, and they care about whether or not they get what they think are results. And that they think results come from Meta because Meta's got great attribution tools.
Right.
Even if a lot of it's false attribution.
Will Danoff, good morning, 92.9 FM up in Boston. Will Danoff, I believe it's his number one holding at Contrafund. And I think he would suggest the reason it's his number one holding is he bought it and he never sold it and just kept adding to it as well. Is that the emotion you feel about Meta, even with these valuations?
That's a really good way to put it. I mean, if someone just held on, obviously they did incredibly well. There were lots of reasons why you should have expected that marketers might have abandoned the platform, let alone consumers.
Oh no, it's terrible.
Nobody cared.
Zuckerberg screwing up. It's
so
terrible.
You got a $200 billion revenue company with Meta here. Street's forecasting 20% top line revenue growth. This is advertising.
Yeah, it's really
What's
stunning.
going on here?
Well, to be clear, they undoubtedly have a more optimistic outlook on the ad market, let alone the economy, than we do. But nonetheless, they're certainly taking share no matter what's happening here. And that's the main thing. They're building these performance-based tools. They're segmenting the market really well. When I say segmenting, I mean finding the marketers who are willing to pay the most. Fun fact, just came out the 10K an hour ago. Their third biggest market, Singapore.
Really?
That's new. Why Singapore? It's a tiny ad market because that's where all the Chinese transshippers are sending all their budgets.
This is like when I talked to Ray YouTube here at Bloomberg, who spearheaded our YouTube effort, Paul. Same thing for Ray YouTube.
How is AI impacting? Is it making their ad tools even better?
Yeah. I mean, the attributed performance, that's the key thing. We don't know that it actually drives performance. Right. But they can claim performance because of the modeling tools that they offer, because they may just be targeting the customer that was already going to buy a product better than someone else does.
Thanks for joining us this morning. Brian Wieser with us. Seema Shaw on deck in London. We'll get to her in a moment. Brian Wieser is at Madison and Wall. Okay, so you were an intern at Sterling & Cooper way long time ago. You nailed this. I remember the IPO day. Paul Kudrowski, David Kirkpatrick. What a magical IPO release we did. Did you see this coming? Did you know in the first year of their public trading that they'd be 23% per year?
Well, we definitely had an optimistic view on the business, not the stock. That's why I had a sell rating at the IPO. But the business itself was incredibly durable. That's why at the trough, if you remember the summer after the IPO, we're like, why is everyone selling this thing? This is a great business. It was always going to be a really good business. And they've got amazing business professionals. That's the core thing.
When you look at the great results out of Facebook here, how do we extrapolate it, can we extrapolate it to Google in the search business?
Yeah, well, at least you can say that there are good tailwinds for growth for advertising overall. Google's not going to grow this fast, but the reality is that if Meta can grow at 20%, you should expect that Google can grow like 10 or something.
What is the...
Google's so much bigger.
Yeah, I know. But my use of Google right now, Gemini gives me what I want right on top. Means I'm not clicking as much. Doesn't that impact Google's revenue if I'm not clicking as much?
There's a lot of threats around that, but we argue that the budgets that marketers have are independent of what consumers do on that level.
Just because it's the time of year, the blue light, the Detroit Lions blue light. Brian Wieser, just because we're here, the Super Bowl, does it, you nailed people will still watch sports. Like you more than anyone I know, you, Nathanson Moffat, nailed in Greenfield. You nailed, it's not going to end.
Yeah.
Super Bowl, it's still a big deal?
Still the single most important event. It is the center of the universe for a lot of the advertising industry. It's not going away anytime soon.
Is the industry like when you were at Sterling Cooper? I mean, is he, Martin Sorrell and all that, and Rob Schwartz, and, is it gone?
No, it's evolving. Here's the thing. I argue, and this is a contrarian view, for all of AI, and there's a lot of fears that AI is going to replace a lot of people. I argue it's going to cause the need for more people because that's more complexity. And the complexity is what requires people to manage the processes. We already saw this in ad tech. Ad tech meaning the automation of most core media buying. It was meant to automate the whole industry. No, it caused the need for more people. And you're going to see that in the creative side of the agency's world.
Warner Brothers Discovery, when you talk to big advertisers out there, do they care who owns Warner Brothers Discovery, whether it's Netflix or Paramount?
So to be clear, while they care about many things about television, like sports in particular, they don't care about television broadly.
Yep.
So when you think about like the Warner cable networks, no. Netflix is still interesting to many because it's an incremental reach thing. And it seems to be sexy, but at the end of the day, TV is diminishing. That's a good way to think about it in the minds of marketers.
Right. Sparta emails. It's Sparta. Thanks for getting out of bed so early. 7:09 a.m. To have Sparta email in this early is a real shock here. We're like devoted to YouTube. Where is YouTube in 5 years? Sparta wants to know.
So they continue to invest in content. They continue to look at this, having the Oscars in 2029. Right? They're not letting up on investment content. Speak of sports, right? NFL Sunday Ticket. That's the YouTube property. They will continue to invest. They continue to share revenue with creators.
Right.
They're spending more than anyone else on earth on content. I think they'll be fine.
Okay, C. Michelle wants to know, is Meta a single best buy? Is it like a buy? Is it a hold? Where are you on this?
I don't have a buy, sell, hold recommendation.
There we go. I needed to hear that. Brian Wieser, thank you so much for getting us started. Madison and Wall this morning there. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
This is a really important conversation. We did thermodynamics this morning.
Yeah.
Physics was great.
That hurt.
This is way more importantly, one of the great words tossed around like a mint, like one of those York peppermint patties. You're at a bar. You want to impress somebody? Well, I'm looking at the liquidity. Jerome Schneider is expert on liquidity. He's at PIMCO, legendary in the short-term paper space, and we're thrilled he could be in studio with us today. When an idiot like me says liquidity, what do we get wrong?
Well, there's two different aspects of liquidity. It's the one that the person thinks about how much liquid assets they need to survive in day-to-day life. And then there's what the macroeconomist thinks about liquidity is, what is the aggregate amount of demand for cash and liquid type products that satiates or sustains business activity? And that's where the intersection comes within the economic cycles. And really, as a functionary, you don't really want to make it too complex. You want to understand that there's risks to both sides. People can over-cherish liquidity and markets can over-cherish liquidity or assume liquidity is there. But at the same time, you want to keep your eyes open that liquidity may not be there at all times at the same cost. And that's really what the lessons of the past 25 years have been for the financial markets.
Can I do an audible quickly, Paul?
Let it rip.
Okay, thank you. I mean, Jerome, your idea of long-term is 2-year paper. Jerome Schneider on the liquidity of private equity and private credit. I don't want to get you in trouble with Dan, but tell me about the liquidity of these new alternative investments.
Well, I think it's one of the things to keep in mind as an investor is you're not only making an investment in an asset, meaning you want the asset to perform, have some rate of return, and a horizon for that asset's return of principal or capital. That's the key metric that many investors overlook. There's some variability in that metric. Many investors make that predisposition because they're assuming economic returns are going to be X% over a period of time. That period of time is going to grow in flux. And I think what we're finding in private credit markets is assumptions that were made several years ago may not necessarily be as concrete as what people had expected to happen to fruition. At the same time, what we are also finding is that there's differentiation in those private markets, in those private credit markets. And really what we're finding is that those assets that might have more resiliency because they're asset-backed in those private credit markets or potentially have the ability to transcend both public and private credit markets have a different, perhaps a more improved liquidity profile than their predecessors. And that's really what we're focused on is in the broader market. Make sure as an investor, you understand what that liquidity horizon looks like and what you expect likelihood to get that maturity payment back or that capital repayment back over that horizon is incredibly important, obviously, to returns.
What do you say to the people that've got that, I don't know, $7 billion in money markets? You go see them at a PIMCO dinner somewhere. You say, hey, come on, folks, get in, buy some 2-year paper here. Let's get into the market here. What do you say to them?
So we've been having that conversation a lot over the past few years, obviously, since we got off the zero bound. And we recognize the fact that it has worked. We have seen people come off the sidelines. We're seeing people move to those ultra short and low duration strategies, about 15% growth year over year. Oddly, though, money market funds are still growing at 12 to 13%. Above their organic growth rate of 3 to 4% interest. So what I would say is that message is making and is resonating, but there's still a lot of cash sitting on the sidelines. That doesn't mean it's all risk seeking. There's a lot of liquidity from central banks, from corporations that is operational cash, but it is sitting on the sidelines. But people are recognizing that with the Fed coming to the end of their rate cutting cycle over the next year, let's call it, you find yourself in a situation where rates are fairly balanced. There's real rates that are attractive, and maybe adding a little duration to the portfolio outside of my long bond, the 2-year point is perhaps an attractive point.
Jerome Schneider, PIMCO, with us. I need to do some economics here. As Mr. Holman was speaking in Minneapolis, claims came in at a stunning 209,000, just above survey. The 4-week moving average of claims, Paul, is worth noting. 206,000. That is just absolutely, it was really addressed by the chairman yesterday. Another non-farm productivity came in on survey at a buoyant 4.9%. And Paul, you and I mentioned this yesterday, the 30-year bond, Jerome doesn't even know the function on the Bloomberg. The 30-year bond, 4.88%, grinding, I say, up to 5%. Paul Sweeney.
Jerome, what did you take away from our Fed chairman yesterday in his comments?
Yeah, first of all, GT30 is the function, so I do know it. There you go.
Do know that. Learn that from Bill Gross.
But I would say that a few things. One, we're obviously data dependent for some period of time here, and I think one of the key facets here is that the tension between jobs and inflation is probably going to be a key theme that we have to see evolving as we sort of dissect inflation or economic data over the next few months. At PIMCO, we believe that we obviously have 1 to 2 rate cuts later on this year, obviously influenced by the incoming Fed chair. But the committee-based approach really maintains the fact that we're going to have to look at it from an economic point of view, recognizing the fact that yes, there's growth that's pretty outstanding compared to where we thought it'd be a year ago, being resilient. And the Fed's going to have to sort of take that into account as they get into the later months of this year. So from that perspective, we might actually find ourselves in a tension that has high growth, inflation that obviously is moving higher over the coming months, but then coming back down to 2.5%. But the need for significant rate cuts beyond the 1, maybe 2 cuts later on this year is not really noteworthy. And I think we are at the neutral rate probably right now. The market's probably going to bifurcate that and cut another, expect another cut or so. But is it meaningful to the broader market? Probably not. And I think a stronger economy and productivity combined with profitability of many corporations is going to be a dominating theme for later on this year.
Is that kind of your call there that you think this economy, is strong and perhaps can even get stronger throughout the year?
There's inclinations. One of the key facets to obviously keep in mind is the fiscal element, the stimulus coming from the fiscal side. The consumerism, yes, we call it the K-shaped economy at PIMCO, and that lower end of the economy is under some stress and duress. But the average remains really, really impressive right now. So you could easily have a growth rate that's about 2.5%. That sort of creates animal spirits from the positive side. And yes, you might have that as a lingering effect that is in the back of the Fed committee's mind as we get into the later half of this year as reasons to hesitate about that rate cut later this year.
Jerome, thank you so much. You really waited around quite a long time to be with us with the Holman press conference. Jerome, thank you for your commitment to Bloomberg surveillance. Mr. Schneider is with PIMCO. Stay with us. More from Bloomberg surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Stefanie Stantcheva, besides the privilege of working under Kenneth Rogoff at Harvard, has become a force worldwide in economics, founder of Social Economics Lab at Harvard. In her latest research goes to the tension that we heard in the Homan press conference. This is the emotion and the anger in society, in our political discourse. Stefanie, this is going to be a 3-hour conversation. I got to squeeze it in a few minutes. How do you measure the rage, the anger of a modern American political discourse?
Yes, that's a great question, and really happy to be with you today. We measure it both online and offline. So we have this amazing data of a lot of social media posts, since 2011. We have campaign speeches, we have congressional speeches. We can compare the same person tweeting online and talking in Congress. So we have this amazing body of data where we can measure, thanks to AI, the emotional content of the statements. And what we can see is that especially since 2016, there has been a really sharp rise in anger. So the share of statements, the share of tweets that are angry has really, really risen.
Right.
And this comes at the expense of the factual or lack neutrally emotional tweets. Other emotions don't show this pattern. So fear, joy, other emotions have been pretty flat.
Right. Professor Richard Nixon, November 3rd, 1969. Is there a silent majority out there in 2025?
Yeah, that's a really great question. But what we see is that this rise in anger is actually very general. So you might think it's on one side of the political spectrum or not. But what we see is that policymakers do follow some cycles. So when policymakers are in power, they tend to have less angry content. And then when they're in the opposition, they have more angry content. And it's pretty symmetric on both sides. But for citizens, it seems like the anger has just risen and doesn't come down anymore, regardless of your political leaning. So perhaps this anger has been triggered by policymaker and now just doesn't come back down. And what we also see is that it seems like anger is used strategically. If you tweet something angry, you're much more likely to be retweeted and to get engagement. If you post something angry, you get a lot more attention. And so this actually reinforces this pattern where angry content is going to spread much more rapidly than neutral content.
So if in fact there has been a rise, an increase in anger in political discourse, does that suggest that centrist type policymaking, is that becoming more and more difficult going forward?
So what's interesting is that anger is not a partisan issue. It is actually very evenly spread on both sides of the political spectrum. And so it is not something that will determine, which side you're on, if you're on the center, on the ends. It does correlate with being more extremely partisan. So it is stronger among people who tend to follow more partisan accounts, who tend to be, more stronger Republicans or stronger Democrats rather than moderate. But what's most important to me is that this really matters for our policies. It matters for economics. What we see is that if you make people angrier, they become more anti-immigration, more anti-free trade. They become more anti-democracy as well. So there's this very strong effect on the policy views that you express. And while this might be short-lived, in the moment, if we are constantly being bombarded by angry content, you can imagine that this is going to persist and have some real consequences.
Social media doesn't appear to be going anywhere soon, Professor. Is there any solution or, change in behavior that may take the rhetoric down and may allow for some more, bipartisan policymaking? So
I'm glad you're mentioning the role of social media here, because we can compare the same person, the same congressperson online, how they tweet, how they speak online, and offline, which means on the Congress floor. And what we see is that for the same person, content is systematically angrier when it's online. So it's not that some people just tend to be angrier than others. It's also that everybody tends to be angrier when they're posting publicly, when they're posting online. So clearly social media does have a role to play in amplifying this.
What are next steps here, do you think? It's this interesting polarization. We all feel it. We all see it. It seems to be growing. Is there a sense that at some point people on both sides, if nothing else, will just grow punch drunk, weary, tired, and maybe you'll start seeing that in toned down rhetoric and policymaking?
So what we see is that this is happening in many countries, actually. So it is not just a U.S. Phenomenon. We have data from France, for other European countries. So it seems to be something more general. And I'm also very curious where it will go and to keep studying that.
Yeah, there's so much to go on here. My book of the year this summer, a couple of years ago, is Paul Pearson and Eric Schickler, professor out at Berkeley. And it's, folks, 300 dense pages. It's called Partisan Nation. And it basically goes from Madison, and then, Paul, we pick up at the Civil Rights Act of 1964, and then the culture war and the raging debate that we're in. Professor, forgetting about the academics, what's the path for America to get back to the middle ground Democrat, the middle ground Republican, the quiet that we used to remember in our parents' political debate?
No, that's a very, very important question to which I don't have the answer. But, what we see in general is that the economic environment matters so much. And especially younger people today are growing up in times which have lower growth, lower mobility.
I totally agree. Wait, this is really important. This goes back to Benjamin Friedman at your Harvard. The bottom line on this is the bargain of economic growth broke a number of years ago. That's the first order regressor, isn't it?
I think it is. And, we can talk about changing mindsets, et cetera. But what I see is that mindsets really follow the reality that people live in and their experiences. And especially, the younger generation we see is living in this time of lower growth, living in lower mobility with a lot of competition, for housing, for jobs. And so this is the reality people live in. So I think before we think about just, quote unquote, changing mindsets, I think we have to think of policies that actually, grow the pie and also share the gains that are happening. So
this K-shaped economy, it's something we've all probably gotten a better understanding of over the last 10 to 20 years. How do we think about that going forward? That doesn't seem to be solving itself as well.
I think, many things are a bit the role of policies. We think of policies as trying to grow the pie or trying to redistribute it in a more equitable way. As much as I love the market as an economist, it cannot do everything. And so I think there's a lot of role for policies. We know some policies literally pay for themselves over the medium or short run. For instance, helping families with children, whether it's on nutrition, education, health investments, those pay for themselves later, create opportunities for lots of generations. Innovation policy. Innovation is something that grows the pie. So I think this is the direction which we need to think.
Okay, Stefanie, you came from Europe. I got time for one more question. We're going to November. We just heard all the tension of Minneapolis in that. What is your prescription where people on the edge of the middle of this nation, in a broader sense, where they have a voice? How do they get a voice given the polarity of our media, the polarity of our discourse? We can't even hold a dinner party anymore between Republicans and Democrats, right, Paul?
Yeah, it's tough out there.
Stefanie, how do we find and go in search of that middle ground?
I think a lot of things are stacked against this. We talked about social media, and even the algorithm is going to tend to amplify more extreme voices. And so I think there's a real structural issue to actually have that type of dialogue and that type of type of debate. So I don't have the answer, but really hoping I can keep studying this.
Do you have Super Bowl tickets? I mean, you're up at Harvard. I mean, did you get Patriots Super Bowl tickets, Stefanie?
I don't have Super Bowl tickets.
Talk to Rogoff. He'll get them for you. Stefanie Stantcheva is at Harvard with important research there on the fabric of our culture. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Let's get right to it. the newspaper's Alexis Christoforous.
Thanks, Tom Soker. We're going to start with a Bloomberg story here. Robinhood now wants a key role in the SpaceX IPO, which we know is supposed to be coming in June. So Robinhood, playing with the big Wall Street banks here, it wants to secure a big block of SpaceX stock to sell directly to retail investors. So it wants to do this through its own platform called IPO Access Platform. And Elon Musk himself has said he's considering setting aside a significant portion of the shares for retail investors. This would be amazing to get in on the ground level, though, right? You're looking at a valuation of $1.5 trillion.
Paul, you're better at this than I am. It's a timeless debate.
It is. And, typically in an IPO, 15 to 20% will be allocated to retail. If it's a tough to execute IPO, even more would go to retail because they're less price sensitive. But this makes a lot of sense. I mean, Robinhood's a huge platform.
Especially for young people.
Yep. And it's a monster IPO. $50 billion is what.
Is there a red herring yet?
I don't think so. I've not seen it. But the bottom line is they're going to need everybody and their brother to be, have access to this deal.
Their brother, their mother.
Is all my radar up on this?
I think it's going to be real. I think it's going to be absolutely fascinating. One of the most fascinating IPOs of all time, in my opinion, because it's the story. It's Elon. It's the size and valuation. It's all there for you.
Just as an aside for 12 seconds, we are preparing over this frigid weekend to send astronauts into orbit around the moon.
Nice.
It's barely in the zeitgeist.
Yeah, that's a good point.
It's true. It kind of got lost in the shuffle.
I think we're talking like early February. They're preparing. They're putting. It's like Formula One. They're putting the decals
exactly.
on a Saturn rocket. Next.
All right. New York Times got a story. The Sundance Film Festival saying bye-bye to Park City, Utah. So it's happening this week, right? You got industry insiders, fans are all making that annual pilgrimage over to Park City. This was started, of course, by Robert Redford, the late actor and director, back in 1985. But they're moving over to Boulder, Colorado. Nice. Why, you ask? Infrastructure, because Sundance has grown so much over the years, but you can't beat financial incentives from the state and the city. Apparently that was even better than Park City. 60% of their programming, first or second time directors, was always sort of the spirit of indie films and indie artists.
What I love about this is you can go out now to Boulder and you can see some new indie film with your Coors Light at the sink.
Yep, exactly.
I mean, you could just sit right there at the sink and have a beverage of your choice, which we did.
Yeah, absolutely. And I think just the festival just kind of outgrew Park City. And quite frankly, Park City doesn't need it. They're packed all season.
Right.
Yeah.
And it's almost like, now I got to make room for these film festival guys. I got to shut down my restaurant so I can host this party and all this.
Sort of like Davos, right? Might be moving. They were talking about maybe having it.
Yeah, sensitive issue. But not as important as this question. Alexis, have you ever had a Coors 3-2 beer?
Oh, no.
Oh, yeah.
Should I?
No, you shouldn't.
No. Okay.
No, that's why Primo exists in the Seattle Rain or whatever it was.
Note to self.
Next.
All right. Business Insider. This is a good one. Why Wall Streeters love expensive gyms. Look, you can spend thousands a month on an Equinox, on a Chelsea Piers Lifetime. They're all here in the city. Now, you might think, Tom and Paul, that the draw here is that eucalyptus steam room or that cold plunge pool. But no. It's about networking, socializing, and guess what? Actually being healthy. So a lot of these gyms, they'll set up designated networking events. So, you would usually go to the bar to do those kinds of things. Now people are going to the gym.
Can I just editorialize? Not that I'm in gyms a lot. The cell phone has ruined gyms.
Well, everything's filmed now. Yeah, everything's filmed now.
They work out. For those of you on radio, you're missing this.
Pumping
and then they look at their phone and go, what's Carol and Tim say on Bloomberg Radio? And then they get back into another exercise.
Hedge fund manager said banks will now take us out and do a workout class instead of getting a drink. It's a good value if someone pays $50 for your Pilates class. Boy, times have changed since my time on the street.
I was going to say, I didn't get that memo. Alexis Christoforous, thank you so much. That is the newspapers for the day.
This is the Bloomberg Surveillance Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.